you should be going into these conversations as a potential equal. You shouldn't be thinking of a relationship as like, please, can I have some money? If anything, you are a prize that doesn't know that it's a prize yet. Really think about what these people are interested in. It doesn't need to be more complicated than you writing something for them to say like, oh, this person's interesting, I want to talk to them. You need to be very careful of what types of rights that you're giving away to these investors, and also what is motivating the investors who are investing into your company. You should be only going to a VC if you have...
Rob Gelb, welcome to the show.
Thanks so much for having me, Ryan.
So let's start off with a really spicy intro question. What are some red flags that founders should look for when they're raising capital from investors?
So raising capital is this weird kind of dynamic where it sometimes feels like you are the product that investors are somehow being nice to you by giving you money. And this dynamic is played on by unscrupulous investors in really quite um, frustrating and despicable ways. So when you're going through any kind of funding round, you need to be very careful of what types of rights that you're giving away to these investors, and also what is motivating the investors who are investing into your company. I think some of the red flags that investors um, sometimes ask for, or some of the red flags that founders should look for when speaking to investors, are what kind of follow-on rights do they have? What kind of liquidation preference rights do they have? We can get into to some of this later. Basically, what happens when stuff doesn't go right or doesn't go well? What kind of rights do they have in terms of selling their shares to other entities? Like most things, the fact of these existing is not necessarily a red flag. The intention behind and the way in which someone wishes to use these tools does matter. And I've seen quite a few businesses get completely bent out of shape, to put it mildly, to utterly destroyed just because of very bad terms that founders didn't understand when they were signing on to them.
Can you go into a little bit more detail about your liquidation preferences and just
And other
unpack that a
things.
little bit? Unpack
So
that a little bit
no,
more. Yeah, yeah. There's a lot of
I'll
terminology in this world, so yeah.
yeah. Okay, so I'll preface this by saying that a lot of these aspects are not actually in and of themselves a problem. A liquidation preference, for example, is where a company has, or a company or an entity or an investor has preference to be paid back on the point of an exit or a liquidation. So let's just say you've invested $100,000 into my company, but you have a very high liquidation preference. So before I get paid out, or before any of the other investors get paid out, you need your money back. Um, Kind of like a very high ranking creditor. But sometimes that liquidation preference has a multiple attached to it. So if my liquidation preference is 2x, that means I need 2 times my investment before anybody else gets their investment out. Which, if you're selling for 10x your business, great. That doesn't matter. Nobody cares. But if you are having to close the company, or if you are being acquired, but for just a little bit more than was invested in, you could end up harming your other investors and you as a founder, if you had signed up to a liquidation preference and just didn't understand what that meant beforehand.
Okay.
As I say, it's not necessarily. If an investor insists on a liquidation preference, that in and of itself isn't bad. It's just understanding what that actually means for different types of scenarios. Another thing is fees. I'm really against fees. I don't think we're talking about VCs here, and I guess maybe we can go into it, but there are a lot of different types of investors. VCs, venture capitalists, are one type of investor, and within VCs, there are many different types of VCs. Like, technically, the term VC is just referencing the fact that a group of people are coming together. There's a formal entity, and it is investing in you. Some people take that as like the highest level, but Andreessen Horowitz, who you might have heard of, is very different to um, Fuel Ventures, to some of these other types of entities out there, to Calm Companies Fund.
Mm.
Technically, they're both VCs, but they behave very, very differently, and they are motivated by very different things. So when I say I don't like fees, I don't like fees when a VC is coming in and is trying to pass themselves off as a traditional VC. When you're talking to angel groups, angel syndicates, this is groups of angels that are going into things. Oftentimes, they will have fees associated with them. Um, I don't like them, and when push comes to shove, if somebody is putting in money into your business, they should be putting it in because they think that they have a very small likelihood of making a shit ton of money. But sometimes they'll have deal completion fees, like they will charge you 5% of whatever the deal is coming in to go back to the entity, which is a bit silly, but happens all the time. Those are a little bit more allowable than like management and monitoring fees, which some of these funds try and do, which I really just hate, where they ask you to pay them for uh, an observer, a board observer, or something every year, and those are just tacky, and I would try and avoid them. And we'll get into ways in which you
Mm.
can engage and how to put yourself forward, how to put the best foot forward. But when you're going through this process and you're thinking, oh, it's typical, I'm going to have to probably pay like 10 grand, 12 grand a year in fees to people. No, absolutely not. And anybody who's interested in investing in you, but also demands that fee and says it's somehow crucial to their business plan or business operations, I would then question why you should be taking their money in the first place.
No one's born with the ability or the knowledge about raising capital. That's a learned skill. So tell me a little bit more about you and your entrepreneurial journey so far, and how did you learn about raising capital in the first place?
I started my first tech company in 20 end of 2016 and beginning of 2017, and it was a classic first time tech company idea that was incredibly poorly thought out when it came to how to actually turn it into a business. So it was in the consumer social space, which is a very, very challenging space to be in. And if you're thinking of like Dunning Kruger, the Dunning Kruger effect, you have this like this part at the beginning called the Mount Stupid, where you don't know enough about a certain topic, and therefore you basically assume that it's relatively easy. I was totally there, and Mount Stupid is incredibly important for a lot of founders, a lot of entrepreneurs, because it propels you to getting into something. You're like, how hard could it be? It's like, well, yeah, it's incredibly hard. And then that's why you fall into the valley of despair. And then slowly, as you become an expert, you then gain more confidence and abilities. I was totally on Mount Stupid. So the idea was a private social networking site for families. So this was if WhatsApp was too busy and if Facebook wasn't private enough, you could use this to share pictures of the baby in the bathtub, that kind of thing. And as an idea, it's still biased, but I thought it was not bad. We had a potential revenue plan. That didn't rely on advertising. We
Mm.
had all this kind of stuff, but we knew that in order to make it happen and make it work, this was going to be pre-revenue for a long time.
Mm.
And in order to do that, you then needed not only some cash in order to survive, but a lot of cash in order to grow.
Mm.
And so from the beginning, we were like, well, the only way this is really going to work is if we took in a truckload of money.
Mhm.
So that's what spurred me into trying to figure out how that whole world works. Even though I might have an accent that might indicate that I should have a network, I had no network. I didn't know anyone who was a VC or a venture capital, like an investor, a sophisticated investor, and just had to figure out like how to do it, which I know we'll
Mm.
get into. Um,
Mm.
and how to build that network. It's not rocket science, but at the same time, it's also very easy to screw up systematically if you're not approaching it a certain way.
Mm.
So that was where I kind of cut my teeth in learning a little bit about how the world of VC works. That venture didn't end up working. We raised mostly angel money, but we weren't able to crack the VC. We weren't able to get the investment that we needed to in order to really kind of not only expand but like give it a proper go. So after about 2 years, we stopped that.
Mm-hmm.
Then I went into a friend of mine who's a genius SaaS builder, had this kind of side project that he was thinking could have some potential, and he asked if I wanted to come in and like take it on and try and commercialize it. So that's called HeySummit.
Mm-hmm.
So I got involved. We put it on AppSumo. If you're familiar with, most people listening probably are familiar with AppSumo, to test the market. Did really well on that. Grew quite well as a bootstrap company. And the product is a online events platform. It's still there, it's still going strong, but virtual events. And we were building in the latter half of 2019 and growing quite nicely. And then 2020 happens and COVID happens, and shit completely hits the fan. We have to go from 5 to 30 people in about a month and a half. We are doing some deals. We are selling to people like $10 a month. Others were doing $100,000 for a one-off event. So there's our customer base is going haywire. Like, who's our customer? Who's our market? All this kind of stuff. So we do end up raising from VC. And that was an interesting process, especially coming from a bootstrap mentality and wanting to preserve some of that bootstrapped kind of DNA. We also disagreed in terms of like how we wanted to grow it. And Ben, the original kind of co-founder or the original founder of the platform, who wasn't necessarily in the business, but he's incredibly astute with how he likes businesses to be built. Very much comes from that bootstrap mentality. In my head, I was like, our competitors are raising a lot more than us. Like, why aren't we doing that too? And so I think it was a good compromise. We ended up raising, not that much, bit over $1 million.
Mm-hmm.
And then trying to build off from that. And there are pluses and minuses of that, which we can go into if you want.
Mm-hmm.
But the then like a lot of things happened. We grew. Someone wanted to buy us. We had to restructure the company, not restructure, like hard restructure, but we had to change the direction a couple times. Um, uh, but it was a wild 2 years. I ended up stepping back, and Ben came back into the business at the beginning of 22. And then since then, I've been helping. I've been working on like some early stage ideas and just helping other founders navigate the kind of investment scene. We were in a relatively fortunate position where we were in a very, very hot VC market at a specific time. So we had that aspect of VCs actually contacting us and like contacting me and wanting to talk.
Mm-hmm.
So understanding how VCs approach this process has been really interesting, because I could just ask them. I asked them why are you interested in us? And not putting them on the back foot, but like having them to justify themselves. And that's a really interesting process that I would encourage everybody to go through when talking about dealing with investors, which we can get into as well.
Mm-hmm.
So that was my journey, and since then I've been helping, mostly just helping friends navigate both their first proper round, multiple, like up to about Series A rounds,
Mm-hmm.
and then also M&A, some like micro M&A. So like, okay, you have this business now, someone might want to buy you. How do you navigate that mentality as well? So that's my background in a very long-winded way.
Fantastic. Well, look, I think it might be helpful if we start at the top and talk about how VC funds actually work, because I think there's a bit of mystery around that for someone who has no network, has never raised capital before, maybe read a book or two, but it's still a bit of a mystery to them. Can you shed some light on exactly how VC funds work?
So VCs are technically they are funds. So they are a group of LPs, limited partners, that come together. They pool their money, and they have an entity, and the fund is managed by fund managers. Those managers then are deciding where to invest this money, and in ways that might get them different levels of return. So on the top level, that makes sense, right? Then when you split through, there are a whole bunch of different types of VCs. But I think what a lot of people think of when they think of VCs, they're thinking of like VCs that like to be associated with power venture, and power venture means that you need that 10x, 100x type return. So I'll just talk about what those are specifically, because I think a lot of people need to maybe misunderstand in terms of what their motivation is. A lot of people think, why does an investor want to throw 5 million at something with no revenue, no nothing, and then if it doesn't work, they're like, oh well, that's fine. Like surely that doesn't happen. Um, and it does happen, and it happens, and the mentality as to why an investor thinks that way, and are just quite happy to say, well, maybe not quite happy, but like is fine washing their hands of investment if it doesn't work, as long as it's quick, is in terms of how they work. So let's just say you have $100 million fund. Your LPs are putting this in. It's the highest risk class for them, right? So your LPs are either high net worths, or they're institutionals, maybe they're pension funds, maybe they're governments, maybe whatever they are, and they're putting their money in a whole bunch of different things. And just like they could put their money in Amazon, they also can put a chunk of their money in you, and that's a high risk endeavor. But that means that the returns that you want to offer are pretty high. So there's this term called an IRR, an internal rate of return, and basically it's a stand-in for how well the portfolio is doing when you don't have access to like public markets. Because if I'm investing in Ryan Corp, it's probably not the case that Ryan Corp is a publicly traded company. So I don't know actually how much is it valued, how much money is there. But I still want to put some money in, and I want it to skyrocket in value. So even at least on paper, the stake that I have for my LPs is rising, and rising quite a bit. But a good IRR, a good internal rate of return, is, let's say, or like a decent one, is about 30%. And what that means, that 30% might not feel super high, but that means every single year it's growing at 30%. So that works out. If you have 100 million fund and you want a 30% IRR, usually funds last for about 7 or 8 years. That means you as a fund need to turn that 100 million into 825 million. That's a lot of money that needs to be made in a relatively short amount of time. So if you have $100 million fund, um, that is you just returning like 5 times your investment, 3 times your investment. If you as an individual are like, hey, I'm going to invest in something and I'm going to get 3 times my money back, you're like, oh, that's great. That's great. We've tripled in size. For a VC, that's not great. That's not hitting it. That's not going towards that 30% IRR. So that's why when a VC is looking at companies, their percentages are really in their heads. Can this investment, is there a way in which this investment can return our entire fund? Like, is that even possible? And so when you're hearing about people saying, well, how can you get to a unicorn status, in terms of your company's valued at $1 billion? It's not just a flippant indicator. It's not just saying, oh, we want it to be massive and balls to the wall and go nuts. There's actually some thought behind it. So if your business, for example, if you're building a business and you're like, we could totally make this into a $50 million business. That is an incredible number. Like, that is an incredible value. That might be incredibly profitable, might be great. It might also be completely wrong for a VC, because so the two aren't the same. I think a lot of people conflate a company is a great company because VCs pump in a whole bunch of money. That's almost the opposite. Like, real companies that are growing really well and are profitable and are delivering returns or dividends are not of interest to VCs, because the part of the market, the part of the risk market that they have, actually they don't have time for good companies, and solid companies in that context, which I think a lot of people might be listening to. If you're listening and you have like a bootstrap company, you're making good money, and you're growing 10% every year, whatever it is, and you see that is a good thing. There are so many other ways that you could then finance expansion or growth or risk than going to a VC. And I think that if though you should be only going to a VC if you have a massive market, if
Mm,
it costs a lot to access that market, right? And the thing that you're doing is eminently like scalable, and you have to do it very fast.
mm,
Those three things, I think, mean that you are then in the sweet spot for VC. Because if you aren't catching fire within a year, even if it's taken a few million to see if you've caught that fire, it is far more efficient for a VC to then say cut losses and go and focus on any of these other bets that they've been putting on that do look like they're catching fire. And that's why a good VC should not be angry, upset, predatory if what you're working on doesn't work out.
mm,
And I think that's why a lot of founders get confused by, because they're seeing big numbers, and these are big numbers for them, but for the VC, just it's not. And it's not that they don't care about money; they absolutely do, but it's the time pressure is just
mm.
as precious, if not more important, for them in their journey towards trying to get to a 30% IRR.
So if you raise capital at the start of the year, you get to the end of the year, and you haven't spent most of that capital, the VC is going to be more upset that they feel like, hey, I gave you money to grow as quickly as possible. You haven't done that. They're more upset that you've grown too slowly at the end of that year, as opposed to you've spent all this money.
Potentially, it,
Mm,
it it very much depends on the dynamics. Like I don't want to paint all
mm,
VCs as being like go 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 go. I think it's about the plan. But a lot of
mm,
VCs will be attracted to you as a company if they think you are on this path, and this
mm,
path means you are going to go out and raise money every year, every year to 18 months, and your valuation then is going to skyrocket and go higher. For them, that's very helpful, because that's
mm,
an increase in that they can point to in terms of their IRR. It's not that they're wanting you to do that at all costs, right? But for them, if you raise money for them because you're saying that you could be incredibly like there's a low chance of us being incredibly fast growth, they're like, great, then I'm investing in your journey to try and see if that's true.
mm,
And when companies don't do that and they take the money and they're like, cool, so we're just going to sit for a while and we're going to be good for like 10 years, that will come across as insincere as to why you wanted this money. And so oftentimes, if that was what was agreed on before, and that then turned out um, to transpire, yeah, you'd piss them off, or you'd piss off a lot of them, unless that was part of the conversation and part of the journey, and all that kind of stuff. Because if you're on that venture path, if you're engaging with VCs, you're thinking, I'm building this company, it's going really well, so therefore the next step is to just get a VC involved. If that's your
mm,
brain, I would just say hold right there. If you're talking about wanting to get into VC and getting on that path, it is a path. So and for some businesses, that's great. That's actually what you want. You want to grow at incredible. You want to land and expand. You want to grow your market share. You don't care about profitability as much. Just in terms of the in terms of the medium term, and you are up for getting investment every year or so, and you are also good with the dilution that will come with that investment.
mm.
If that's not what you want, then just don't assume that's like what you have to contort into in order to be successful.
Can you change direction halfway through? Can you come in, raise a bunch of VC from the very beginning, change your mind, and then decide, no, 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 actually, we'd rather bootstrap? Or once you're on that path, you have to stay on that path?
No, 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 no. Like there's been some good examples of that. So like Buffer. I don't know if folks
Mm,
are familiar with Buffer and their story. They went through AngelPad, which is a pretty well respected accelerator program. Postmates also went through it, and a few other like kind of higher profile unicorn direction companies went through it. I think they were definitely positioning that in their initial investor cap table seemed to be on that trajectory, and then they decided they wanted to switch gears, and they wanted to become, I think they want to eventually become like an employee owned company, and they want to change things. And they've written a lot about this,
mhm,
and they're quite open in terms of their whole journey. But yeah, they went through that, and they talked with their investors, and they worked out a way in which they could buy themselves out eventually.
mm,
Obviously, investors are I'm not saying they weren't pissed off or anything, but investors are people and they're humans, and if your heart isn't in it for the way in which it needs to be for them to get their exit, it is not usually in their best interest to be dicks. And they are people. There's definitely, could be frustration, but if you go in and you consciously say, you know what, I don't think the business is there, I don't think the unicorn business is here, a $50 million business is totally there. I think
Mm,
we're going to switch gears and try and articulate that. So let's have an open conversation about what that means for our relationship going forward. That
mhm.
totally happens. It absolutely can happen.
I know the VC landscape has changed a little bit in the last few years. What is the fundraising environment like right now?
The last few years has been a bit rocky for a whole bunch of different reasons. Kind of you can talk to
Mm,
the post COVID return to work. You can talk about the kind of financial uneasiness with inflation and increasing of interest rates. Wealthier people are less requiring of higher risk investments if the interest rates are high.
mhm,
Uh, you will also have people who point to all sorts of different reasons why this is the case. You also have a correction by the VC market in general, um, from the amount of money that was in the system
mm,
in up to 2021.
mm,
And there was a lot of money, a lot of VCs, a lot of cash going to startups, and a lot of startups that maybe shouldn't have gotten the valuations that they had, and they shouldn't have received the money that they had. So
mhm,
this kind of overcorrection, um, combined with the general economic environment, all come together to say that yeah, it's been a bit tough for the past couple of years when it comes to VCs, um, especially in that period like post seed, where you'd have a company that would have raised at a much higher valuation before,
mm,
and now there's not that appetite to invest in the multiple of valuation that they would need in order to see a good like a good indication for their existing
mm,
investors. What that means in normal terms is money still is getting invested. Uh, Angels are still investing money. Early stage VC is investing money. Uh, mid range VC is investing money. They were holding a lot of dry powder for a little while. They are investing more now. The sectors have switched a bit. There's less interest, still interest, but there's less interest in bog standard SaaS that isn't uh, revenue generating. There's more interest in AI. That's the latest, um, stick that the dog's interested in. There's less interest. There was less interest in crypto. Crypto had a bit of a crash, and the money that went along with investing in crypto reduced. That, depending on who you read, it looks like it's changing a little bit, but or that it's coming back a little bit. Um, VCs are usually a bit more hesitant, and ironically, they are more interested in cash efficient and revenue
mm,
efficient companies now. You have a lot of things that VCs are saying that, from a bootstrap perspective, you're like, no shit, this is how we think all the time. But before, a VC might say, um, growth at all costs. We don't
mm,
care about profitability. We don't care about this stuff. Boom, boom, boom. Whereas now you're hearing those same people say, well, you want to be responsible, and you want to be growing. We want to see revenue growth, and as a core part of the business, especially looking at Series A. And so what you end up seeing is a lot of these investment categories, like seed, pre-seed, series A,
mm,
shifting a little in terms of the types of traction and the types of evidence that they need in order to justify an increased investment. So, short version is, yes, VC landscape has changed a little bit. It does seem to be coming back in terms of money is being available. It's pinching companies most in that post seed stage. Early stage companies, there's still quite a lot of money available, and also VCs themselves are getting pinched by their LPs in terms of, like, are they actually delivering something that's of interest to them to invest in?
You used a word there, traction, which is pretty interesting. That's a word that gets thrown around a fair bit. What does traction mean for an investor?
Traction is the stand-in of evidence that you are on the right track. That means different things to different people at different stages. So I think a lot of people might think traction is money, and it could be. It could be money. It could be revenue. Revenue is the best form of traction, but if you do have revenue, then then they're going to look at revenue growth. So how much are you growing? So as soon as you have revenue, you have to be very careful that you are growing it at a fast enough rate for someone to be satisfied. But it doesn't have to be revenue, especially in the earlier phases. And depending on the type of investor that you're going to, what evidence is there that that your hunch is being borne out? Maybe that's user growth. Maybe that's activity that people are taking. Maybe it's bandwidth in terms of what proportion of somebody's day are they spent on your app or tool.
Mm,
Um, it is a way in which you can show evidence, some sort of evidence that what you think is going to happen may indeed happen.
mm,
So if you're listening and you're at a pre-seed stage, which ironically pre-seed stage sounds like you just have an idea on a napkin, whereas now that's all been moved up. So you've been going for a little while, and maybe you have some revenue and you have all this kind of stuff. It doesn't mean that you're profitable. It doesn't mean that you're efficient.
mm,
But it means that if I'm an investor and you're walking me through this and all of my little niggles of like, well, how do you know this? How do you know that this is true?
mm.
You can then say, well, we don't know, but we're pretty comfortable, confident in thinking that we're on the right path to knowing that it's true because of X, Y, and Z.
I had a friend once who said it's easier to sell the sizzle than the sausage. So what he meant by that is exactly what you said. Once you demonstrate that you're generating revenue, you're on the hook to demonstrate that you can grow that revenue very quickly, and you've got a pathway to doing that. Like, do you agree with that? His point was that if you are going to raise, especially a first round of capital, you're able to get a better valuation, and it's easy to sell it if you're just kind of dangling the potential in front of an investor, as opposed to, hey, we're generating revenue, it's not much but it's there, but we might be able to grow it. Or do you think you're better off generating revenue and using that as your traction?
Well, so it's a good question. I think you talking to a lot of people, especially about the world of VC, you start getting into like games, and you're trying to play games, and you're trying to understand the game that they're playing. I really don't like that. I don't find that super helpful. I think when it gets down to it, that is a mask for how how much conviction does somebody have in a particular idea or a particular team. And so I don't think it's true that like, okay, you have some revenue but you don't have a lot, therefore you can't raise. I don't
Mm,
think that's necessarily true. It's part of it is the story, like why,
mm,
why do you not have a lot? And that's an honest why, not a why aren't you much better than this? It's more like what is the reason? Are you doing a whole bunch of experiments and you're having a bit of revenue and you're actually actively saying, yeah, we could pull that thread and we could get like 10x our revenue in the next 2 years, but we know that's it. It'll stop. And frankly, that's not as interesting to us as over here in this area, this shiny area that we think is actually a much bigger opportunity, but we can't access that yet. And so the reason why we want to raise a chunk of money so we can go and access that and see if there's gold there. So yeah, look at our revenue right now as proof that we know how to get revenue if we want to, but the revenue growth is immaterial because the real opportunity is over here. That kind of a narrative makes sense. Like
yeah.
it could make sense, and that also could be a good reason why you were wanting to raise capital from someone.
Mm,
Whereas a non-power venture VC might look at that and be like, "Are you mad? Why
mm,
aren't you? Why aren't you going down and like making money?" You know. So it very much depends on what it is that you want. I don't think you need to raise with revenue. Revenue is the best indicator that there is something there, but you have to combine that with the story, the narrative, and a really good bit of conviction in terms of like, why do you want this wad of cash? Why don't you go off and extrapolate or extract all of the money that you can in this one thing so you can power that one thing later on? Maybe you don't have the time. great reason to raise capital then.
Mm,
There's this opportunity. It's not going to be there for a huge amount of time because the
mm.
vultures are circling, and our competitors are looking at that too, and we just see that this is a massive opportunity. Comes with that a whole bunch of bravado and silliness that sometimes people take, but you can still be quite successful with that approach.
Right, but you've got to have, if you are going after power venture, then the story that you tell has to align with that whole, we're on this time frame, we want to accelerate as quickly as possible, and the more closely it's aligned to that
Yeah,
ethos,
exactly.
right?
I think some founders, especially bootstrap founders, are find it hard talking with power venture VCs because you are very eager to come across as competent and realistic, and um, that can come across very well. It can also come across as that your ambition is not as high as it may be, um,
Mm,
or that you have doubts when you're talking to this other person who does not know the business as well as you, and they are not necessarily seeing the inherent excitement and drive that you actually have.
mm,
um, I see this a lot where people will jump in, and I was like this too. If I talk to an investor, I will spend the whole time telling them why this isn't gonna work. And an investor who needs to figure out whether or not this may be the thing that returns, this may be the one company that returns their entire fund, doesn't really want to hear that. They know that it's probably not going to work. They want to see all the different routes available for it to work, even the outlandish ones, so that they can be like, "Oh, cool. These guys are thinking about all sorts of different things. I am inspired by their energy." So an investor will rarely know the business or the sector as well as you. The investor does not need to know and should not want to know it better than you. Otherwise, they should be building their own company. What they want to know is they want to have confidence that you are the horse to back because you are obsessed with this thing and you are not going to sleep until this thing gets built, so that they can feel a lot more secure and increase their conviction that even if you figure out your way by going all the way around, you're the one that is worth investing in.
What should you do to prepare for your first meeting with a VC? And what sort of questions should you ask them in that meeting?
Definitely look up the VC. Like look them up on Crunchbase. Look them up on. I mean, you can look them up on Bowhurst and some of these other ones, but Crunchbase is the easiest. Look and see what is their average investment amount. What kinds of things do they invest in? All of the VCs will talk about their portfolios on their site. Look them up. Learn a bit about them. If the VC has come to you, I think it's different as to whether or not you've been introduced to the VC or the VC comes to you, or otherwise. But there are a few different kind of questions and questions areas that I would just be up keen on asking them anyway, just so that you're getting something out of the conversation and it's not just them. Some of those are just asking a little bit about the fund. So, tell me a bit about the fund. How far along are you? When you ask that question, you're talking about the length of the fund. If you are in year 8 of a fund, of an 8-year fund, that means that they're not going to be around in a year, or at least they're not going to be deploying. I mean, well, a year 8 and an 8-year fund, they're not going to be talking to you. Let's just say they were year 4 in an 8-year fund. That might mean that they're not necessarily going to be deploying a lot of new capital. So you want to know. So okay, so how much are you holding back? How much do you hold back for follow on? A lot of VCs will hold back, let's say 50%. So that means they will 100 million fund. They'll invest the first 50 million, and then they'll hold back the second 50 million, or maybe usually they'll do 25 or 30. Hold back the remaining 60 or 50, so that they can follow their money and double down on the ones that are most likely to be able to return the fund. So asking them that question, it's not a rude question to ask. It's just showing that you are interested in them, and it's an important question to ask because knowing that this VC has a lot of if they soft circle half of their investment as a follow on, that's helpful. That's good. It also means though that the next round they're probably going to be good for max double what they've put in. So that's good to know as well. what is their thesis? Are they a generalist fund? Do they have a thesis? They probably will talk about their thesis a lot, but you can ask them some intelligent questions on that. Like, if they say that they're generalists, ask them why they're generalists. Like, why aren't you focused on things? Do you find that makes you less of an expert in different areas? Like, what kind of value do you add if you're just a generalist? If they are a specific subject matter expert, okay, so what trends are you seeing? Like, why do you find this space that we're in so interesting? Who do you think are the big players? Who do you think is doing it right? This kind of conversation, I think it's based off of the idea that you should be going into these conversations as a potential equal. You're not going in as some sort of um, beta, right? An investor you shouldn't be thinking of a relationship as like, please, can I have some money?
Yeah.
If anything, you are a prize that doesn't know that it's a prize yet, that they might have a little potential to get on board with just before you like blast off. So you needing and on the flip side, you coming in and being a complete dick is also not, I think, very helpful. Though some investors do actually respond very well to that, of like you just being an ass and telling them all the stuff, all the shit they don't know. I don't advocate for that. I think
Mm.
you should lean into your personality in terms of what is most comfortable for you. But there is a difference between you coming in and showing your expertise and not being afraid to disagree, and like rolling over and being like, oh yes, yes sir, absolutely, absolutely. So when you're going into a conversation, I would prepare for it in that way. I'd be like, find out the stuff that you don't know about this thing, these people that you might be getting in bed with one day, and just ask them, see what their response is like. you know um Depending on who you talk to as well, I would be um mindful of the information that you're giving out. Uh, in VCs, you have different levels. You might have an associate or an analyst, then you might have a principal, you might then have a partner, managing partner, people like that. Partners are the ones that usually make decisions or are decision makers, and they are the ones that are probably going to be a lot more interesting to talk to. Associates will talk to 20 different companies, 10 different companies a day. They're going to be writing up stuff. They're going to be making presentations. They're going to be tracking you. So anything that you say, they're just going to be putting you on file. If a partner wants to talk to you, that is a little bit more like, I think a bit of a better indication that they are interested in being serious. And oftentimes, or the one thing that you usually will not hear in through an investor conversation that I know is really irritating to people is no, is this isn't for us. If and that can be super super frustrating to founders. So when you are on conversations, especially initial conversations, remember your time is valuable. You should be out there building your business, and anything that these people are doing to take you away from that is costing you money. So don't be afraid to be like, cool, so what's your process like? How fast do you guys actually do this? Basically, like, how are you not going to waste my time if you are interested in proceeding? And last thing I'd say is that um, as soon as the competition does weird things to people, and it suddenly makes people much faster than they previously purport to being able to be. So you will have VCs that say, well, every month we have this meeting, and then we'll get all the different pitches in, and then we'll talk, and then we'll circle back, and then we'll start having conversations about people. So the earliest we can like get an indication back for you from initial interest is about a month. And then you'll come back and say, oh yeah, by the way, someone's giving us a term sheet next week, and you'll get something, the same day. Right. So it is a little bit of this game that you have to manage, but hopefully that gives a few things that someone can look into in terms of when they're wanting to chat with
Mm.
or their first or second or third chat with these VCs.
How many meetings does it usually take? Or how long is a piece of string? Like, is it a one and done kind of meeting? Is it, by the third meeting, if it's like, well, it's the third date, is this going to happen or not? Like, is it that kind of a dynamic, or can you be talking to them for 6 months without getting a commitment out of them? Like, what
Yeah,
does that
I
look
mean,
like?
it's all the above, and I think it depends on when you consider it starting.
Mm.
So, like, the best time to start building relationships with VCs is when you're not raising, when you're honestly not raising. Most times when founders get in touch with VCs, they're like, "Oh no, we're not raising right now, but we might be in a few months," i.e., they are and they will be. But if you're honestly not, and we can get into this in terms of the a little bit later in terms of like tactics. But if you're honestly not, like that's a great way to just start building a relationship. You have to be mindful about the information that you're giving, so that someone's like, oh, hey, yeah, we chatted 3 months ago, and you said you'd be at this revenue level by now, and now you're still at the same revenue level. Like, what's going on? So you need to be kind of mindful of that. But if you are actively raising, if a VC is actively interested, um, it can depend. I mean, I have had situations where I've met an investor and I walk out with a check, which
Mhm.
is I think rarer than people like to think. Um, but usually it's like 2 or 3 calls. Then you might have to meet with a few different partners, and then if they were to issue you a term sheet, then due diligence might take a few more calls, or a few more meetings. So it can happen very fast. There are some funds that pride themselves on making incredibly quick decisions. More likely that's in the States, and more likely that's on the West Coast of the States. But or in the very early stages, like they have set terms, set things. It's such a low likelihood, or like such an early phase that, yeah, we can just put it in. Depending on the mechanism that you use as well, we can talk about safe notes versus
Mm.
equity investments. Um, that makes things easier or harder, or takes longer. So yeah, it is a little bit like a how long is a piece of string. I've seen deals, massive deals, take like 6-9 months to organize, and also massive deals happen in a couple weeks. And also smaller deals that just take forever. One of the big things that you can do as a founder to truncate that time is to just assume that it won't happen and build up the alternative that will drive action. So if you think of yourself as like a canal boat, right, between two locks in the canal, if you're in the middle of those locks and the water isn't equal on the other side, and you try and open that door, it's just not going to work very well, not going to work out very well. Whereas if you make it so that both options, both directions are the
Mm.
are as equal to your level as possible, it'll be pretty easy to be able to go in either direction. So if you are putting all your hopes on one VC to invest in you, and you've been talking to them and nobody else, it's probably going to take a long time, because they're in the pole position. They can take as long as they want to see if you're the real thing. Also in M&A, if you're talking to only one person, one entity. So if you want to get into more control, or to take on more control of that process, it's not trying to push them. It's trying to go off and just assuming that it's not going to happen and come up with an alternative
Mm.
that will ironically drive them to action a lot faster.
How much equity should you expect to give up every time you raise capital?
The generalized rule is anywhere between 15 and 25%. Again, this is a big generalization. I'm making a whole bunch of assumptions, but it ends up being, especially in tech, especially in SaaS, especially in VC, when you're doing a full round, you are expecting between 15 and 25%. So that's why just settle on 20%.
Mm.
That means that every time you go through a round, you are diluting yourself and the existing cap table by 20%. If you might also add another 10% on that, um, either before or after, for option pool, like if you're creating an option pool as part of that to retain and incentivize employees. But in general,
And are there any other common mistakes that you see founders make, especially the first time when they're raising capital, and especially from VCs?
one of the areas that's complicated, I think, or maybe difficult to get your head around, is the idea of valuation and how to value your company. Because, and especially when, ironically, when you're talking to unsophisticated investors, they can really set you on the wrong path. So just that question that you just asked, what percentage should you be giving out? 20%, right? Pull that out of there. What does that actually mean? It means that you are dictating the valuation of the company based off the amount of the percentage that you're giving out. That doesn't sound normal, and it shouldn't be, but that's how it is. So realistically, if you have someone who if you want to raise 1 million, you need 1 million. Uh, then you're going to be valued at about 5.
Mm.
And that's how you get to that valuation of 5. And you justify why it's 5 for in whatever way you want. That whole concept is weird. It's fundamentally weird because it sounds backwards, and it is backwards. But it is the only kind of it is the only rational way to get around the fact that the company doesn't hold a huge amount of value,
Mm.
um, and until later. You are valuing a company on future potential, and it's very difficult to then make that up. The problem that I think a lot of founders make, or the challenges that they run into, especially if you're coming from a bootstrap background, you like real numbers. So you're like, well, how the hell am I justifying 5 million? 5 million, what, 5x my revenue? I'm nowhere near a million in ARR. Like, how can I justify that? So that's a bit of a mind, a mind screw. But the other thing is miscalibrating your narrative and what it is that you want to do based off of what you think someone else wants to hear.
Mm.
You're like, okay, I have a call with Sequoia, and therefore I need to contort myself into this weird thing and come in there all brash and, and try and pretend like I'm going to be the next Elon Musk and all this shit. And then when you don't, like, maybe they're just interested in talking to you, and also maybe they're not the right fit for you anyway. So it shouldn't matter. So that's the kind of the big thing. Valuations and not understanding how valuations work, and also contorting yourself. Um, Unsophisticated investors screw people up by making it a bit more real
Mm.
too early. So if you have a bunch of dentists that want to give 100 grand or 10 grand, they want to put 10 grand into your business. Usually they end up saying, okay, cool. So what's your 5-year financial plan? Show me your EBITDA over, the next 5 years. And I'm going to interrogate every single thing, because this is my money. I'm investing it and all this kind of stuff, which I know it sounds normal, but like that's not how power venture or power venture scale, or usually early stage tech works. And it's a fundamental misunderstanding of risk appetite and viability.
Mm.
And some angel groups really screw up companies that way, because they're like, well, no, the maximum amount that you're going to be valued has to be like 300,000.
Mm.
So we're going to invest 100,000 in your business, and we're going to take 30%, 33% of your business. And then an investor looks and says, you want this to be a power venture business. You've taken only 100 grand, and you only have 2/3 of the business left.
Mm.
Ooh, that's not good. If you're going to be going through round after round after round and diluting yourself, at some point you're not going to have any more equity. So why would we be putting in like tens of millions into your business if you're not motivated to stay?
Yeah, so if you take a bad deal at an angel round at an early stage, that can potentially screw up your ability to raise
Totally.
capital from VC later. Yeah.
Totally,
Okay.
totally. Now, as with most things, there are ways around a lot of this stuff, and sometimes VCs, and this is another reason why VCs sometimes have a bad name or have a bad rap and are predatory or seen as predatory, um, especially by angel investors, because they've probably experienced a VC coming in and cleaning up the cap table. There's this phrase, cleaning up the cap table. And that can be anything from getting people removed from the cap table and like wrapping them into something, might be changing rights and behaviors and information rights that people have. It also just might be reorganizing how much of the business certain people own. And that can be if you imagine, like, let's just say you went from a 10% holding of a business that you invested 5K in, and now the business is taking off, and Sequoia is interested, and they come to you and say, man, Sequoia might invest like 10 million into my business, and one of the requirements is that you drop to 0.2%. And you might be like, well, F no, so like but they might be doing that because they're predatory, but it also might be doing that because the founder needs more of, they might feel like the founder's equity allocation is a danger, not only to from their investment, they're thinking of the next investment round. If they don't, VCs want things to be as straightforward as possible. They
Mm.
don't want surprises, and they want it to be easy for someone else with even bigger pockets than them to come in on the next round. So if they see something that's not that doesn't make sense or that is weird, they're going to question it. So you as a founder can then think, well, how much work can I do to try and minimize that to make it as easy as possible. And again, if someone really loves you, they're gonna work with you. They're gonna try and figure this out and help you. But it ends up being gets you into these very interesting problems where you have a really crappy few angel rounds that you did, and the founder is like just scraping 50% and they've only raised 100 grand, and now they really are catching fire, and yes, it can totally screw up deals.
Let's change tack a little bit and maybe go deeper into some of the tactical stuff. How do you find investors in the first place?
Investors are naturally accessible, relatively accessible.
So, final question, Rob. Are there any other little hacks or tips or bits of advice that you give to founders to help them get more favorable terms?
Having a good lead investor that you trust a lot helps make a lot of arguments because you can then blame it on the lead, right? Oh, investor majority consents aren't being given. I mean, lead. Yeah, that's what they want. So actually, making sure that you have a good lead, super valuable. Thinking about things like not doing equity rounds, and just doing convertible notes, at least for the early stage, like safe notes. Safe notes are not technically an investment. They are safe notes in the States or over in the UK, advanced subscription agreements, ASAs. But this is like a money that is being transferred to your account that will do one of a few different things in the future. It might convert into shares. It might convert into a loan that you then have to pay back. It might do a whole bunch of different things. Convertible loans are great because you can have, as long as the loan is the same, or as long as the note, the legals, it's like a page. It's not very long. You can have one open as long as you're using the same legal. Uh, uh, and you don't have to wait for everybody to be ready to invest. If you're like, oh, we want to raise like 1 million, and we found someone who wants to put in 100 grand, send them a DocuSign. They have to sign it, and then they can transfer you that 100 grand, even if you don't have the other 900 lined up. So convertible notes are very cheap. They're very good way. You need to be mindful of them to make sure that the terms are good, because that can screw people up. I think other hacks. Uh, I wouldn't engage in the earliest phases. I would not engage in like a professional, like financier, someone whose job it is to introduce you to investors. Personally, I think at the later stages, absolutely, especially with larger amounts
Mm.
and sector specificity, totally it does make sense. But if you're raising your first 500,000 or million or 2 million, you really should be owning that yourself and owning that whole process yourself. And I think you will end up finding that it's actually not as bad as you think it is. Um, uh, Books. I have a couple book suggestions. If
Mm.
in terms of like learning a little bit more about it, I think uh, there's a book by Oren Klaff called Pitch Anything that's really good. He's a psychologist, and it's a great way of kind of articulating in a much better way that I have about that need to establish yourself as a subject matter expert and not beta yourself or and come in as an equal and establish that,
Mhm.
especially when speaking to investors. It's very good, very accessible. Then Founders Dilemmas, great book, and Wasserman uh, definitely prompts the kind of conversations that you need to have with a co-founder. If you're starting off, you need to make sure that you guys are aligned in terms of what it is that you want. If a 50 million exit is really sounds great to you, but your co-founder is like, I want to do 1 billion or bust, uh, then you guys should talk about that and make sure that you understand what that means. Um, and it talks about control motivated people and wealth motivated people, and it's a really interesting book, and it prompts some great questions.
There has been so much gold in this, man. Thank you so much for doing this. That was Rob, if anyone is interested in getting in contact with you, where is the best what's the best way to find you?
You can go to robertgelb.com and you can connect with me there. I'm also on LinkedIn. I will definitely see you on there. You'll probably see some very embarrassing looking images of me in a cast, and lots of cartoon pickles because that seems to be my life right now. But yeah, reach out. Happy to chat.